Hi everyone, today we'll be going over accounts October-November 2021, paper 3-3, question number 2. This is structured paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours, which means that we will be attempting to solve each question under 30 minutes. And this is question number 2, which is a part of section A, which relates to financial accounting. Without any further delay, let's get started. The following information relates to D Limited for the year ended 31st December 2020. We are given the revenue, purchases, gross profit margin, which is of 40%, non-current asset turnover, current ratio, trade receivables turnover, trade payables turnover, and we are told that all sales and purchases were on credit. So these revenue as well as purchases both are on credit, and the value of closing inventory was 20% higher than the opening inventory. So this just means that the closing inventory is the opening inventory plus 20% higher than that. So that's 0.20 times opening inventory. We can write it down as closing inventory equals to 1.20 times opening inventory. Okay, then the current assets consisted of inventory, trade receivables, and cash equivalents, and current liabilities consisted of trade payables only. Okay, first let's figure out all of the values that we get from these set of information. All right, so the first part is the current ratio. Let's do that. So for current ratio, that's 2.2:1, and we know that the current ratio is just the current assets divided by current liabilities. So that's 2.2 times 1. This means that current asset is just going to be 2.2 times the current liabilities. And what we know is that the current liabilities consisted of trade payables only. So we can figure out our trade payables from trade payable turnover. Okay, I'm just going to write it here. Trade payables turnover is 45 days. And we know that the formula for trade payables turnover is just the trade payables divided by our credit purchase times 365 days. That will be equal to 45 days. Now we need to figure out our trade payables because the credit purchase is given right here. This purchases and all of it is credit, so this amounts to 642,400. Let's substitute that. So that's trade payables divided by 642,400 times 365 equals to 45. This means that our trade payables is just going to be 45 times 642,400 divided by 365. So the trade payables is just going to be 45 times 642,400 divided by 365, which results in 79,200. And since current liabilities consisted of trade payables only, this is the amount of the current liabilities as well. Let's substitute that amount here. So that's just going to be 2.2 times 79,200. So this gives our total current assets to be 174,240. Okay, now we can figure out our trade receivables from trade receivables turnover with the similar process as we did for trade payables turnover. Okay, I'm just going to write it here. So the trade receivables turnover we have of 33 days. And the formula for trade receivables turnover is just the trade receivables divided by credit sales times 365 days. We are given our credit sales right here. So revenue, this amounted to 1,051,200. Let's substitute that amount. So that's trade receivables by 1,051,200 times 365 equals to 33. So this just gives the trade receivables to be 33 times 1,051,200 divided by 365, which results in our 95,040. All right, so we are done with our first information, second information, trade receivables turnover and trade payables turnover. We also did the current ratio. So now we have the gross profit margin. So gross profit margin is of 40%. Okay, this just means that out of revenue, 40% is going to be gross profit. Then the remaining 60% must be associated with our cost of sales, right? So let's figure out our cost of sales because we are already given our purchases. So cost of sales is just going to be 60% of revenue. So that's 0.60 times the revenue of 1,051,200. This gives our total cost of sales to be 630,720. All right. So wait, I'm just going to figure out an area that we can work. Okay, so right here. So we know that our cost of sales, we just figured it out to be 630,720. And what we know is that the cost of sales consists of the opening inventory plus purchases minus the closing inventory. And this will be 630,720. Okay, so we have our opening inventory. The purchases amount was given above. Let's have a look. So purchases amounted to 642,400. Let's write it down. That's 642,400. And we are also given the information associated with opening and closing inventory. Right here, the value of closing inventory was 20% higher than the opening inventory. So we figured out that we can write our closing inventory as 1.20 times opening inventory. Let's do that. So that's minus 1.20 times opening inventory. And this will be 630,720. Okay, so the one opening inventory minus 1.20 opening inventory is just going to be minus 0.20 opening inventory. And if we are to bring this amount to the other side, that will be 630,720 minus 642,400, which results in a negative balance of 11,680. Now we can easily figure out our opening inventory. That's just going to be negative 11,680 divided by negative 0.20, which results in 58,400. Now we can easily figure out our closing inventory as well. Closing inventory is just going to be 1.20 times opening inventory. That's the equation that we found from the given information. So that's 1.20 times the value of opening inventory is 58,400. So this gives our total closing inventory to have the value of 70,080. Okay, so we also made use of the third information. Now we have our non-current asset turnover of 2.4 times. Let's solve that one as well. So we have non-current asset turnover of 2.4 times. And we know that the formula for non-current asset turnover is just the sales divided by total assets. And that's 2.4. And this will only be the non-current asset. Alright, we are given the value of sales to be 1,051,200 divided by the non-current assets equals 2.4. So this gives the non-current asset to be 1,051,200 divided by 2.4, which gives our total value of the non-current assets to be 438,000. All right, so we solved, or we made use of each of these information. Now let's have a look at the question. We need to prepare the total assets section of the statement of financial position at 31st December 2020, showing the cash and cash equivalents as the balancing figure. And we also need to use the space provided to do your workings. All right. So what I did was I scribbled all over the question paper. You guys should not be doing that. Do these workings in your working section. All right, let's prepare our assets section. And this is just the part or the section from the statement of financial position that only deals with the assets. Okay, so firstly we will record our non-current assets. We just now calculated or figured out our value for the non-current assets above. Let's have a look. We figured out that the non-current assets had the value of 438,000. So let's record this. That's 438,000. Now we can move on to working towards our current assets section. And we were told that the current assets section only consists of three things. So the first one is inventory. The second one is trade receivables. And the third one is the cash and cash equivalent. And this will actually give our total assets. So let's have a look above. We already figured out the closing inventory and trade receivables. Okay, so the closing inventory amounted to 70,080. Let's write it down. Then trade receivables, we figured it out to be 95,040. Let's write it down as well. Now we also figure out our total for current assets using our current ratio. And the total for current assets is right here. So that's 174,240. This is the total for current assets section. Okay, so we can easily figure out the value of the total assets, which is going to be the sum of these two amounts. That's 438,000 plus 174,240, which results in 612,240. But we are still to figure out the value of the cash and cash equivalent. And this will act as a balancing figure. And in order to figure out the balancing figure, we just deduct all of the values from our total. So that in this case, that's going to be 174,240 minus 70,080 minus 95,040, which results in 9,120. Alright, this concludes our assets section of the statement of financial position at 31st December 2020. And this also concludes the first part of this question. Now we can move to the second one. Whatever workings I did all over the question paper, you guys should be doing that inside this particular box. Okay. Now we need to calculate the working capital cycle in days. So working capital cycle is just the trade receivable turnover. This is going to be in days plus our inventory turnover. This is also going to be in days minus the trade payables turnover. So we're given the value for trade receivable turnover and trade payable turnover in the above information section. And now we only need to figure out the value of the inventory turnover. So let's do that. We know that the inventory turnover is just going to be average inventory divided by cost of sales times 365 days. We already figured out our cost of sales in the above information. Now we need to figure out the average inventory. And average inventory is actually just going to be the sum of opening inventory plus closing inventory divided by 2. So let's have a look above where we figured out the values for opening inventory and closing inventory. The opening inventory is 58,400 and the closing inventory is 70,080. Let's write it down. So that's just 58,400 plus 70,080 divided by 2, which gives our average inventory to be 64,240. Alright, so average inventory is 64,240 divided by the cost of sales. Let's have a look above. We already figured out our cost of sales to be 60% of revenue. And the total cost of sales amounted to 630,720. Let's write it down. So that's 630,720 times 365 days. So the inventory turnover is just going to be 64,240 divided by 630,720 times 365, which results in 37.18 days. And since we're talking about days, we need to round it off. And whenever there is a decimal while figuring out the number of days, we always round it off one number above this number. So if there's a 37, we round it off to 38 days. Alright, now we can just substitute the values for trade receivables turnover, inventory turnover, and trade payable turnover. Let's have a look above. You can see that our trade receivables turnover is 33 days and the trade payables turnover is 45 days. Let's substitute this. So receivables was of 33, inventory turnover we recently figured it out to be 38, and the trade payables turnover is actually of 45 days. So this gives our working capital cycle to be 33 plus 38 minus 45, which results in 26 days. This concludes the second part of this question. Now we can move to the third one. We are given additional information. So the following accounting ratios for 2019 are also available. So whatever accounting ratios that we just figured out and were given in the question, it related to the year 2020. We have the non-current asset turnover of 2.05 times, and we have the working capital cycle of 30 days. We now need to compare the performance of D Limited over both years by considering the non-current asset turnover and working capital cycle. So this is for the year 2019. For the year 2020, we were given the non-current asset turnover to be 2.4 times. And we recently figured out the working capital cycle for 2020 to be 26 days. So now we just need to compare. If we are to compare the non-current asset turnover, we can clearly see that it is higher for the year 2020 as compared to 2019. And we know that non-current asset turnover is just the sales divided by asset. And this just means the efficiency of assets in generating the sales, right? So if the non-current asset turnover is higher for the year 2020, what we can say is that the assets are more efficient in the year 2020 in order to generate revenue. Let's write it down. 2020 has a higher non-current assets turnover than 2019. This suggests that 2020 is more efficient in utilizing its non-current assets in generating revenue. Alright, now we'll compare the working capital cycle. Again, we can see that 2019 has a higher working capital cycle than that of 2020. And we know that the lower the days, the better the working capital cycle, which means that the working capital cycle is better for the year 2020. And we know that working capital is actually the net current asset. So what we can say is that the shorter working capital cycle represents the better ability of non-current assets to generate cash. Let's write it down. 2020 has a shorter working capital cycle than 2019. This suggests that 2020 can generate cash from its net current assets in shorter time as compared to 2019. So in conclusion, what we can say is that in terms of non-current assets turnover and working capital cycle, the performance in 2020 is way better than that of 2019. Let's write it down. In terms of non-current asset turnover and working capital cycle, the performance in 2020 is better than 2019. So this concludes the third part of this question. Now we can move to the fourth one. We are given additional information. The price earnings ratio of D Limited has increased from 2019 to 2020. So we know that the price earning ratio is just the share price or the market price of the share divided by our earnings per share. And for this ratio to increase, either the share price should increase or the earnings per share should decrease, because this is the general rule of maths. Whenever we're talking about a fraction number, in order for this entire fraction to increase, the numerator term should increase and the denominator term should decrease. Now we need to explain two possible reasons for the change in the ratio from 2019 to 2020. So like I said before, the first one could be that there is an increase in the current share price. Let's write it down. An increase in the current share price. And we also need to write down why this increase in the current share price could have taken place. We know that the share price is just the market price of the shares that is being determined by the investors' supply and demand. So what we can say is that since there is an increment, there could have been an increased confidence in getting a higher profitability in the future by the investors, because the investors would only be ready to invest more amount or greater share price only if they see a possibility in getting a higher profit in the future. Let's write it down. Investors have confidence in getting a higher profitability in the future. Alright, for the second part, the price earnings ratio can increase if the earnings per share will decrease, right? Let's write it down. A decrease in current earnings per share. And we know that the earnings per share is directly influenced by the profit that we earned. So if there is a decrease in earnings per share, this could have been possibly resulted from a decrease in the profit. Let's write it down. A decrease in current profit. And we know that the profit decreases if there is higher expenses. So let's write it down as well. Due to increased expenses. Alright, so this concludes the fourth part of this question. Now we can move to the fifth one. We need to state 4 limitations of ratio analysis. The first one is that the ratio analysis is always based on historical information. And we can see this because whenever the financial statements are published, it is actually a year away from the actual time of those transactions, right? So if we're talking about the financial statements of the year 2020, it will actually be published in the year 2021, by which time those data would have been historical information. Secondly, inflation is not taken into account. So if we are to compare the financial statements of 2 consecutive years, even then there is some sort of inflation, right, which is not adjusted. So definitely we can see some sort of increment in our values from last year to the current year. But if we were to adjust inflation, maybe there would be no changes, right? So we do not do that. That's a limitation. Inflation is not taken into account. Then thirdly, there can be different accounting policies of different businesses. So if we are comparing ABC Limited to XYZ Limited and we are looking at the assets value, then let's suppose that the ABC Limited uses the straight line method, whereas the XYZ Limited uses a reducing balance method. Then obviously there is a differences in accounting policies, so the comparison will not be valid. Let's write it down. Different accounting policies. Then lastly, this is based on the business type. So I cannot compare 2 businesses from different industries based on their ratio analysis, because this would be invalid because they both belong to different business groups, right? Let's write it down. Based on the business type. Alright, this concludes the 5th part of this question as well as this entire question. If you found this video useful, make sure you Like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.